So I'm covering taxation of resources and covering some of the flow-through share information, so of interest to many of the junior public mining clients out there. It's been around for a while. I'll go through it rather quickly. I think we're a bit behind on time, so we'll try and get through it quick and cover off as much as possible. Otherwise, we can obviously cover things later on. We'll try as our best to wrap things up by 4 o'clock so that we can hit the drinks at that point. So we've got a few things that we're going to cover. Just a brief look at how expenditures relating to exploration and development are treated for tax purposes. There's some special treatment of them. A quick overview as well of flow-through shares, what they are and how they work. Some of the more common errors that we see and what things that are focused on by CRA when they're auditing the flow-through share program. And then the last, just a few items on some provincial tax credits and incentives that are out there if you're eligible. So to start, CEE and CDE. So these are basically exploration and development costs for a mineral resource or an oil and gas in Canada. And so the special treatment is really, instead of it just being treated as an ordinary deduction as part of your net income or your tax loss, that ends up falling into your non-capital loss pool and it gets carried forward. They get carved out and put into separate pools that have their own sort of rules that go. The benefit to them is really by having it in a separate pool is that the carry forward period at this point is indefinite, whereas with non-capital losses, they can expire, albeit 20 years down the road. So not as critical as it used to be when the carry forward period for losses was only 7 years. So what are Canadian exploration expenditures? Well, essentially there's a purpose test to start with. So they're incurred for the purposes of determining mineral or oil and gas resource, so either the existence, location, extent, or quality. So that's really the first test in looking at any type of expenditure that you're incurring. For that particular pool, it's the deduction that you can take for the costs that are in there there is a limit on the deduction. So if you're what's known as a principal business corporation, which you'll see later on, especially with the flow-through shares, really your primary business is mining or resource. If that is the case, then the annual deduction for this pool is limited to the lesser of your income for the year and the balance that's in the pool. So if you have a loss for the year, then basically you can't claim any of the deduction. So you can't increase your tax loss for the year. Some additional points on exploration costs. So generally they include prospecting, drilling, geo, digging, sampling, those types of costs. Specifically excluded are development costs, which we'll cover off in a moment, or expenses that are incurred once the mine's already in production, essentially what they would say in reasonable quantities. So development costs are basically bringing a new mine into production, and they generally include things like clearing the land, sinking mine shaft, underground entry, the actual purchase of the right to the property. So when the acquisition occurs, the cost or the amount paid would go into this pool, but it specifically excludes things that would fall into CEE or the exploration so that there's no overlap. In this case, the deduction limit, and normally when you sell a property, the proceeds from that sale would go and applied against the CDE pool and reduce that pool down. If there's any balance left over, then it gets added to income and it gets treated as part of the net income for the year. The deduction limit, again, there is a limit on it. It would be the greater of the proceeds or 30% of the pool. So if you had a loss, you could still claim 30% of the balance in that pool at the end of the year and claim that. Something that's a special carve-out that relates to both exploration and development costs are what are known as CEDO, or the overhead expenditures that come about. These specifically do not qualify for the flow-through share program to be renounced. We'll get into that momentarily. But they basically include sort of admin type costs. So admin, management, financing costs, profits on payments made to a connected person. So where this commonly happens is if you've got a management company that's been consulted by the public company holding the property to do whatever type work on the exploration side, if that company or that person or related group hold more than at least 10% or more of the shares of that public company with the property, then there's restrictions on how much can be treated as CEE when it comes to things like drilling costs or other types of costs that you would commonly think would fall into CEE. Because there's a connection and there's almost a related party situation there, they say that we won't allow you to recognize the profit component of the payments to that management company. So let's say, for example, it costs the management company $100 to do the drilling. It charges the public company $120 for that work. Well, the $20 portion of that component would get put into CEDO instead of just CEE, because I guess CRA or the government felt that you could easily inflate the costs that go into CEE and use that towards things like flow-through if there wasn't some type of a restriction on it. The other couple of areas are salaries and wages of persons where their duties don't represent at least 90% exploration and development. So if you've got officers that are also have corporate compliance side that they need to also deal with, that can be sometimes problematic depending on how much time is spent on each. The same threshold basically applies on things like repairs and maintenance, insurance, leasing of assets. So those assets or that insurance needs to relate to the actual exploration, not for things like office type costs and that sort of thing. So that was a quick overview. So now flow-through shares. Generally, well, there's a few areas that we'll look at quickly. The background of the program itself. What are flow-through shares? What sort of costs are eligible that you can renounce? How the look-back rule works. What the stacked or two-tiered renunciations are and how they apply. Just some brief advantages, disadvantages of doing flow-through and issuing flow-through shares. And then just a quick summary of what compliance you have to incur if you are going to issue flow-through shares. So just a brief background on it. They're basically just special common shares that are issued by what I had mentioned earlier, a principal business corp. They're primarily, their business is mining. That's the industry. So if you're not a principal business corp, you would not be eligible to actually issue flow-through shares. So that's the first test that would have to be met. And the other thing that would need to be recognized is that it needs to use all those funds for eligible exploration work. So if you're using those funds for admin type costs, you want to minimize that, or you'll need to raise some other dollars in order to cover that off. Otherwise, you might go offside. Ultimately, what happens is the tax deduction that gets passed on to the investor, they get to claim it on their tax return. In some cases, you might have credits that are also connected to that, either the federal one or some provincial ones, depending on where the investor is located. So, brief diagram just to show a little easier how it works. So you've got a flow-through share investor, subscribes for shares in the corp, we call PBC. It then spends its money on the Canadian resource property that it owns or has Title II, it doesn't necessarily have to have title, but that's usually the case. The costs are then basically treated and renounced up to the investor. So it would be basically passed on from the company up to the investor, so the company no longer can use those. And then the investor claims it on their tax return. So flow-through shares specifically, they're generally issued through subscription agreements that have certain stipulations in them. One, of course, being that you're committing to spend the dollars on eligible costs and that you're going to renounce those costs onto the investor. One particular thing, it can't be what's known as a prescribed share. Basically, prescribed share would have additional benefits and features. So aside from the actual flow-through aspect of it, it can't have things like limiting your loss or other types of rights and restrictions that don't apply to other common shares. The amount renounced, of course, can't exceed what consideration was received for those flow-through shares by the company. And in most cases, there's an indemnification agreement or indemnification clause in that subscription agreement, which is where the company issuing those shares has to really be careful, because if you go offside and you need to indemnify investors for their tax loss or their loss of tax deductions and potentially credits can be a significant amount. And in some cases, you could be looking at 65 to 70 cents on the dollar of what you've raised would ultimately have to be paid to the investor to indemnify them if for some reason you either didn't spend it on eligible things or there was a shortfall in that spending. The investor no longer gets that deduction for their tax purposes, and then they're going to look at the company to basically being reimbursed for the taxes that they had to pay because of that. So eligible costs, they're generally known as grassroots CEE. Up until, well, I guess next year, they'll be eliminating this after next year, but the first $1 million of development costs were possible to reclassify or renounce as if they were CEE and treated that way. The key is that the costs have to be incurred after the flow-through share agreement is signed or agreed to. So you can't warehouse costs that happen or that were incurred prior to actually having that agreement. You actually have to incur them after that date. So it's key to make sure you're aware of the timing of the agreement and when the expenses were incurred. They have to be incurred within 24-month period. And they're generally renounced by the end of February of a year following that 24-month period. What's known as super flow-through shares also have an additional federal investment tax credit of 15% that go along with it. So costs that aren't eligible, as I mentioned earlier, CEDO or overhead type costs, they don't count. Personal or living costs, capital costs of depreciable properties. So obviously you're going to need equipment, things like that to do drilling. If you were to purchase the equipment, you wouldn't be able to treat that as flow-through share expenditures. You'd have to lease the equipment, that would qualify. Seismic data, so off the shelf that you've acquired, and bulk sampling. So if you've sold sampling or you've taken some samples and say you're digging for gold, you could have a fair amount of value in those samples that when it gets sold, there's proceeds coming back from that. If the revenue from that can be connected and is as a result of the exploration work that was done with the flow-through money, they will deny that portion of the cost. So you have to be careful. You probably want to wait until, I mean, it's easier said than done because it's usually a cash flow matter, but you'd probably want to wait until later to actually sell your sampling so it doesn't end up tainting your cost for the flow-through share program and your obligations under that. So the look-back rule. So that generally the way this works is that there's a way that you can actually renounce those expenditures to investors before you actually incur the costs. So often what will happen is the flow through will be renounced on December 31st of year one, and then the eligible costs are incurred throughout year two. So you're still on side, and the benefit of that, of course, is the investor gets the deduction for tax in year one, but you haven't actually had to spend the money until year two. So there's an acceleration there for the investor to recognize it. The one thing to keep in mind, though, is that it doesn't come for free. There's what's known as Part 12.6 tax, which is effectively on a 1% annual basis, but each month you have to look at how much has not been spent yet for what you've committed to spend over that program. So you end up having a cost of that for looking at it on a monthly basis. And if by the end of that second year you haven't spent it all, whatever you haven't spent, there's another 10% tax on that portion. So what is a stacked or two-tier renunciation? So quite often what you'll see is a public company may have a subsidiary that actually owns the property, but the public company is the one that's issuing shares and raising the capital from its investors. So what has to happen is the subsidiary has to issue shares to the parent that meet all the same conditions as the flow-through shares we had already talked about, and it then renounces it up to the public company before the public company then turns around and renounces it up to the investors. Now, the thing to keep in mind is it's not eligible for look back. So it's often done on a monthly basis that you renounce it, so that by the end of the year you've got a full amount that you can renounce up to the investors of the public company. So it's a much more heavier compliance exercise. You basically you end up duplicating the work at a minimum. But in some cases it works out better. You don't have to move the property between the companies, and in some cases it's not possible to do so. So again, a brief diagram on how that two-tiered works. So you've got your investor subscribing for shares in the parent company. Parent subscribes for shares of the subsidiary. The subsidiary spends it on the property in that first year, turns around, renounces it up to the parent. Parent then turns around, renounces it up to its investor, and then basically same rules would apply. So what are the advantages? As I mentioned, immediate tax savings to the investor. Often in companies in this situation are in a loss position, so they don't really need the expenditures. It's a good way to raise capital. It's easier to sell to investors than just a regular common share. Disadvantages, there's when the investor sells those shares, there's zero cost base on them, so the entire amount, assuming they're holding it as capital property, the full proceeds would essentially be a capital gain to them. And of course, the other disadvantage, there's a fairly high compliance requirement, and if you go offside, it can be quite punitive. So I'm just going to quickly run through these. So the T100 is essentially, you have to apply for an ID number that gets you in the system with CRA. There's a filing deadline. You want to make sure you meet it because the penalties can be punitive. Once it's actually, you're in the course of it, the T101 is what reports to the investors what amounts you're being renounced and how much their deduction is. If they have any tax credits, it picks it up there as well. If you had to amend or reduce the amount of flow-through amount, you'd file a T101B just so that it reduces the penalty that would happen if you had a shortfall on what your spending obligation was. The T101C is just calculating that Part 12.6 tax that I had mentioned. And then the T101D is not as common, but it basically summarizes if you received assistance, so government assistance in some way reduces how much it costs you really to spend that flow through. The T101, it's the month ending following the month of renunciation, so it's a pretty tight deadline. You want to be on top of that. T101B, generally this happens the following year because you're then determining how much you've spent and what your shortfall is, so you want to amend those T101 slips if you're in that situation. If you don't, then you can be forced to by the government, and then it costs you penalties. And then, as I mentioned, T101C, this is where the Part 12.6 tax is calculated. So for the one thing to keep in mind, for the compliance requirements, Quebec has its own version of all these forms, and they file with their own government. Where you have to be aware of this is in some cases it might be obvious. You have an investor, it shows where they reside, so if they're in Quebec then it's pretty obvious. The challenge is where your investor is a limited partnership is usually where we see this, and it's not clear. There's no list of who the partners are of that partnership, so you don't know that there's actually a Quebec resident in there. That forces you to file on the provincial forms. So in most cases where you have a large partnership that's subscribing for the flow-through shares of the company, it's best to either confirm with them who their investors are or who the partners are of that partnership, or just as a default file the Quebec forms regardless, so that you're not offside. So just some of the more common errors. Completing forms, that's often, can be confusing at times and not always clear cut. More often than not, it's late filed forms that end up causing the grief. Commonly as well, ineligible costs are renounced, so using flow through for every type of expenditure, that'll get you in trouble quickly. Stacked renunciation, so as I mentioned, where you've got a parent and subsidiary, it's quite often where the company won't realize that they do have to do that share issuance and duplicate their compliance and their tax filings so that they're on side. And then the Part 12.6 tax, overlooked or forgotten. From the CRA audit perspective, where we usually see things, they're unsupported or ineligible costs that get renounced, so it leads to a shortfall. The company may think they're on side. Turns out after the audit that they're not. Quite commonly, the audit happens 5 or 6 years after the fact because there's an extension of the statute barred period for flow-through share. So usually what you'll see is, there'll be a reassessment that's, 5 years down the road. You might have different management, you might have, can't locate the investors, things like that. So that can be a challenge. And then, as I mentioned earlier, if you're a connected person and you fall into that category, the management, admin fees, things like that, the profit component of is left in those costs without realizing. So there's arguments to be made, but if the shareholding is over that threshold, then you're in a bit of trouble. As I mentioned, the implications if your spending shortfall is the case, the investors get reassessed, they get less deduction, they end up paying more tax. There's a 10% tax on the shortfall as well, and there's usually indemnity clauses, as I mentioned, in those agreements, so now the company is on the hook to reimburse the investor. And ultimately, it's a tough investor relations issue and something you definitely want to avoid. So just quickly to run through, BC mining exploration tax credit, 20% refundable, which is a nice bonus. It's been extended again, so it's still available. You have an additional 10% if you're in that mountain pine beetle area, so that's a nice bonus. And fortunately, there's a longer period to file, so you've got 36 months from the year end to file it. The BC mining flow-through share credit, This can also be passed on to the investor if they're a BC resident. They can claim it. It's non-refundable, but they can also carry it forward or back. Quebec resource tax credit, it's similar in the concept. What types of costs and exploration costs are eligible? It has a higher refundable rate, which depending on which region in Quebec it is, you need to have a permanent establishment in the province, and you cannot double dip in the sense that anything that was raised for flow through and you spent for flow through, you can't turn around and then claim the tax credit as well on it. So it's either one or the other. Quebec mining tax refund, this is a provincial program they have. If you're in production, you're paying. If you're in exploration, generally you're getting refunds for what you've spent in Quebec. The deadline is tighter, so that's one thing to keep in mind. It's only 6 months. So overall, several rules, a lot of compliance rules to watch for. So if you are issuing flow-through shares, just be mindful that you have to stay on top of it, or the penalties can add up. Making sure that you're spending it on time and you don't end up with a shortfall. The costs that you're incurring are eligible so that you're not in that same position. And then, as I mentioned, watch for limited partnership investors where you could have Quebec filing requirements too. Same thing goes for stacked renunciations. Make sure you know that there's 2 layers that you have to file, and that if you're going to claim the provincial tax credits, make sure they're on time. Otherwise, you could be denied.